Most people put their money in stocks and bonds. The ultra-wealthy do not stop there. 5 investments dominate the portfolios of the richest families on earth. Most retail investors hold none of them. Number 1 will change how you think about building wealth. We rank these investments by 3 factors. First, historical return. How much have they actually made? Second, access barrier. How hard is it to get in? Third, outperformance. How much do they beat what the average investor can access? All 5 require either significant capital, accredited investor status, or specialized knowledge. These barriers are not accidental. They are what keep the returns concentrated at the top. According to the Federal Reserve Survey of Consumer Finances, ultra-high net worth families allocate more than 40% of their portfolios to private market assets. The average American household holds less than 3%. That gap is the story. This is not financial advice. These investments carry significant risk. Most investors have never considered owning a single acre of farmland. The wealthy have owned it for generations. According to the ENCRI Farmland Index, agricultural land returned an average of 11% per year over the past 3 decades. That includes both income and appreciation, 11% annually, from land that grows food. Farmland earns returns in 2 ways. The first is rental income. Farmers lease the land and pay the owner a percentage of crop revenue. Cash rents on prime agricultural land in the Midwest run between $200 and $500 per acre per year. That translates to a cash yield of 2 to 4% on the land value alone. The second is appreciation. Arable land is a finite resource. Demand for food rises with global population. Supply cannot expand. That arithmetic drives long-term value growth. What makes farmland truly compelling to wealthy investors is its behavior during market stress. When the S&P 500 fell 40% in 2008, U.S. farmland values held flat. When inflation spiked in 2022, farmland appreciated because crop prices rise with inflation. It is a real asset that correlates with almost nothing else in a portfolio. Warren Buffett has written about his Nebraska farmland investment as one of the simplest and most satisfying he ever made. He bought in 1986. He has received income every year since. The land is worth many times what he paid. Retail investors were historically locked out because acquiring farmland required buying entire farms. That meant millions of dollars. Now, platforms like AcreTrader allow accredited investors to buy fractional shares of farmland for as little as $10,000. But the accredited investor threshold remains: a net worth above $1 million or income above $200,000 annually. The door has cracked open, but for most people it remains closed. Number 4 is one of the fastest growing asset classes in the world. Most retail investors have never heard of it. Private credit is the practice of lending money directly to businesses without using a bank. Here is the structure. A mid-sized company needs capital to grow. Banks will not lend at a rate that works. A private credit fund steps in and provides the loan directly. The fund charges an interest rate between 8 and 12% per year. That interest flows to investors in the fund. Compare that to public bonds. Investment-grade corporate bonds yield around 4 to 5% today. Private credit yields are roughly double that. The trade-off is liquidity. Private credit is not publicly traded. Once capital goes in, it is locked for typically 5 to 7 years. Investors who accept that illiquidity receive the premium in exchange. The sector has grown dramatically. Private credit assets under management exceeded $1.5 trillion globally. That figure reached that level in 2023. It is larger than the GDP of Spain. Firms like Apollo, Ares, and Blackstone manage the largest private credit funds. Minimum investments for institutional quality funds start at $1 million. Some require $5 million or more. Business development companies offer partial access to retail investors, but the best returning vehicles require accredited or qualified purchaser status. Private credit is money working for the already wealthy at double the yield the average investor can access. Number 3 is real estate, but not the kind most people know. A real estate syndication is a pooled investment in a large commercial property. We are talking about apartment complexes with 200 units, industrial warehouses, self-storage facilities, student housing developments. These assets cost between $10 and $50 million to acquire. No individual retail investor buys a $50 million apartment complex alone. A syndication groups 50 to 100 accredited investors together. Each contributes $25,000 to $100,000. A professional sponsor identifies the deal, negotiates the purchase, and manages the property. Investors receive a share of the returns. The typical structure pays investors a preferred return first. That preferred return generally runs 6 to 8% per year on their invested capital. After that threshold is met, remaining profits are split between investors and the sponsor. Target total annual returns on well-structured deals run between 12 and 18%. But the financial returns are not the only advantage. Commercial real estate generates depreciation. A paper loss the IRS allows that offsets taxable income. In a well-structured syndication, investors may receive depreciation benefits that shelter their income from taxation while still earning positive cash flow. The ultra-wealthy use real estate syndications as cash flow engines. A high-income professional earning $400,000 per year can use depreciation to reduce their tax bill. They simultaneously earn 8% preferred returns on their invested capital. Access is improving. Platforms like CrowdStreet and Fundrise have lowered minimum investments, but the highest quality deals, the ones with the best sponsors and the strongest projected returns, still move through private networks and require significant capital. Number 2 is the investment that wealthy families use to build generational wealth across generations. Almost no one in the retail investing world talks about it. Buying an existing profitable business, not starting a business from scratch, buying one that already works. This concept is called acquisition entrepreneurship. You find a small business with consistent profit, a plumbing company, a dental practice, a software firm, a landscaping business, and you buy it. Small businesses typically sell for a multiple of their annual profit. That multiple commonly runs between 3 and 5 times earnings. Think of it this way. A business earns $200,000 per year. You buy it for roughly $800,000. That same business, run well, continues generating $200,000 annually. Your return on the purchase price is 25% per year, before any growth. The U.S. Small Business Administration backs acquisition loans up to $5 million for qualified buyers. With an SBA loan, you can acquire a profitable business for as little as 10% down. Buy an $800,000 business, put down $80,000, finance the rest through an SBA loan at current interest rates. Hire a manager to run the operations, collect the cash flow. This is precisely what private equity firms do at scale. They acquire businesses, improve them, and eventually sell for a multiple of what they paid. The model works at every size. The barrier here is not capital alone, it is knowledge. Finding deals, evaluating financials, negotiating price, managing operations, executing the sale years later. These are learnable skills, but they require intentional education that most retail investors never pursue. Index funds are easier, and the people running private equity know it. Number 1 is the investment that defines the structural wealth advantage of the ultra-rich, and it has done so for more than 3 decades. Private equity. Private equity means owning stakes in private companies, businesses that have not yet listed on a public stock exchange or that have been taken private by an investment firm. Here is the core insight. The average company today stays private for 12 to 14 years before going public. Amazon went public in 1997, but most companies that became the tech giants of our era spent years, sometimes decades, growing in private hands. Retail investors could not buy a single share during that period. By the time these companies IPO, the major wealth creation has already occurred. The private investors captured it. Retail investors arrive last. Over a 20-year period, U.S. private equity has outperformed the S&P 500 by roughly 4% per year on average. That gap looks small. It is not. Over 20 years, 4% extra per year is not a small gap. On a $1 million investment, that means roughly $3 million in additional wealth. $3 million extra from 4%. The minimum investment for institutional quality private equity funds starts at $1 million. Many require $5 million. access requires qualified purchaser status. That is a regulatory tier requiring 5 million or more in investable assets. The ultra-wealthy allocate 30 to 50% of their portfolios to private markets. The median American household has effectively 0%. This is not a secret. It is a structural feature of the financial system. Private equity returns persist because the best opportunities never reach public markets. By the time something is available on a public exchange, the early money has already been made. Platforms like EquityZen and Forge have opened limited access to secondary pre-IPO shares. Some pension funds now offer private equity allocations to employees. The access gap is slowly narrowing, but the core dynamic remains. The best-performing private equity funds are close to everyone except the wealthiest institutional investors and families. Private equity is number one because it is the investment most definitively separated from the average person by design, by structure, and by law. Here is what all 5 of these investments have in common. They are not exotic. They are not illegal. They are not secret. They are simply structured to require capital, accreditation, or relationships that most people do not have. The wealthy invest in private markets because private markets offer something public markets cannot: inefficiency. Public markets are efficient. The price of Apple stock reflects every piece of publicly available information. Anyone in the world can buy it at the same price. That efficiency compresses returns toward the average. Private markets are inefficient. Information is unevenly distributed. Access is unequal. Pricing is negotiated. And in that inefficiency, superior returns live. The 5 investments on this list: Farmland, private credit, real estate syndications, business acquisitions, and private equity, represent the private market allocation wealthy families rely on. These are the assets that have allowed them to compound capital at rates public markets cannot match. The access barriers are real, but they are not identical. Farmland platforms accept $10,000 from accredited investors. Real estate syndications accept $25,000. Business acquisitions can be financed with government-backed loans. The knowledge barrier is often more limiting than the capital barrier. The true wealth gap is not income. It is access to asset classes with superior risk-adjusted returns, combined with the financial education to understand them. Retail investors are not excluded because they are unintelligent. They are excluded because the system was not designed with them in mind. Understanding these 5 investments is the first step toward the access they represent. This is not financial advice. Past performance does not guarantee future results. If you found this useful, subscribe to CashCinema. Drop a comment with the investment you want us to analyze next. Every dollar has a story.